Halftime Report, Fast Money, and many, many others. Please help me welcome to the stage Dr. J, Jon Najarian.
Thank you. Thank you. Thank you guys very much. My pleasure to be here. We're going to keep the lights up mainly, even though I think I could wake you up if you started to fall asleep. But after lunch, probably not a good time to have the lights turned down. I'd encourage you also to do just what Zach was saying a minute ago. Make sure you do take a look at the silent auction items. It, of course, supports the same thing you guys supported with your tuition or whatever for the conference. All those great charities that were at least a big part of why I think a lot of us came here, was to support that. And then ever since Nate and Scott and Zach and Kristen and all the great people that I've been associated with here, I am amazed, guys, how wonderful and straightforward you guys are as traders. Because I meet an awful lot of traders or trader wannabes, and they tend not to be nearly as open as you guys, or as willing to share and things like that. So I applaud you, not only for supporting the causes here, but also for being good people. Traders, of course, high testosterone, type A types usually, and they can tend to be, you know, on the asshole side. They can be. Not all of them are, but some can be. And I'm sure you guys know them just like I do. And we get to talk to some of those guys on TV about it too. But most everybody I've met here has been exceptional. And so again, thank you guys. It's a great group, Nate, that you guys have gathered. And you're doing a great job with this. So I wish I would have started earlier. But next year, I'll make sure I get my brother Pete out here. By the way, folks, other than the silent auction, at the table out front, we have a card that if you guys fill it out, it's got a bunch of things that we do, which include this Investitute, which is like education for derivatives trading and things like that. You'll get free access as part of that, no credit card. We're not like taking your credit card and then you forget and then we're automatically charging you or anything like that. You just have to fill out the card, tell us what you want. Everybody who does will send you a book as well. That's just a little sort of a thank you, and so you can see if what I'm really talking about, we really do. Because in our chat room, I guess, sort of like Traders Underground, we talk about trades all day, and the people in the chat room can talk back and forth to us and to anybody else in the chat room. So it's pretty neat, on the high end at least, for the people who are really actively trading when we see unusual activity in something like Open Outcrier sees, like Sang Lucy over with Wall Street Jesus. I know it's Jesus, but any of those types of things. We're not pretending we're the only guys that have eyes on this stuff. We've got algorithms that do that. I'm going to show you how we break it down and how we see this stuff. But I think that it's a great community. So like the community that most of you guys are in right now, we have that kind of community for day-to-day talking back and forth with people about the trades too. And if you just fill that card out, you'll get everything that I just spoke of. All right, with that, let's see, I guess I can just hit the first button and we start. That's kind of what trading looks like these days, right guys? I've been at this for 36 years. I'm going to give you guys a little background and tell you some funny stories, and I'm going to show you in depth what we do and how we do it, because I think that's important. That's kind of partly why we're all here, is to learn something about how this really gets done. But I'm lucky enough that when I came to Chicago, I came to play football for the Bears. And even though that was a very short career for me, I was lucky enough that it brought me to Chicago. But I thought I'd start with a slide like this because it's kind of snarky. I feel like Chris Irons, you know, starting with this slide or my next slide. But everybody keeps saying, you know, when's the bull market going to be over? The bull's out there taking a bow again as we trade, you know, to record highs again all week long this week. But just like the director's telling the bear, not yet, not yet. Sometime it'll happen, and it probably will be more than that 5% that we've been seeing It'll probably be more like a full correction, but there's lots of opportunities in the markets. That's what I talk about. That's what I love to talk about every day. Lucky enough to be able to do it on TV. So the guy on the right in this picture, there's of course a gentle lady and a gentleman. The $16 trillion woman and how she's been managing it, I think, very well. Again, some of you would disagree with how the Fed has become so active, whether it's plunge protection team or whether it's just keeping rates and basically crippling savers. We all understand how that works. It's gone to the borrowers, and the highest quality borrowers get the best benefit from that. But nonetheless, there's an awful lot of money that's been pushed at the markets here. And Mr. Cohen, who kind of has his eye on that position, and I still think is one of the front runners because he's already in the Trump administration, I think he is going to be feeling a little of the heat, and that's why I picked that particular picture for Mr. Cohen. My brother Pete and I. So quickly, Pete played 6 years in the NFL, 2 years in the World League. He was a great football player, 3-time All-American, 2-time full All-American, not just academic All-American. He was pre-med. He ended up not becoming a doctor because he played so long in the NFL. But every year on his way to or from camp, he'd stop in Chicago with me, and he'd see what we were doing on the trading floor, and eventually, just like you guys, he got addicted to it. And so when his career was over, he came down and learned it faster than anybody I've ever seen. I've never seen anybody learn it as fast. I don't know all of you, but that guy is amazing. And he's a huge trader, too. Again, I know there are big traders in this room, but Pete, when things were crazy in AOL, he was our #1 trader there. For him to carry million share positions and not sweat it was amazing to watch. He made an incredible amount of money doing that and having the balls to do that, because that's difficult. I'm not kidding you, I can't carry positions like he can. Once I get to a certain level, and you guys will notice this for yourself, the blinders come on and I can't see because I'm so focused on just that trade right there that I can't really let the trade work for me. Pete's just the opposite. And it's not that he doesn't understand or respect money, but he's really good at managing risk. And so when he's trading that kind of size, and again, he'd carry, like I say, on an average day, he'd trade 1 million shares of AOL back in the day when it was an $80 stock. But he'd carry 200 to 500 million in stock with options against it. I mean, and when you were a floor trader, which is what I'll get to in a sec as far as my background when I started, we could carry 200 to 1 leverage. How would you guys like to trade 200 to 1 leverage? Well, if you rented a seat or owned a seat on any of the US options exchanges, you got that. Plus you got that mixed straddle election, which meant we paid basically 28% top rate because you get long-term mixed with short-term capital gains on the treatment to encourage you to basically trade as much as possible, because we're supposed to create a fair and orderly market and take the other side of whatever's coming into the market. So for that obligation, we got that benefit. But anyway, so that's my brother Pete. He played for Seattle, Vikings, Tampa Bay, the Raiders, and then he played 2 years. He was the #1 draft pick in the World League after that. And he's one of the reasons that they have the helmet cam and the mic'd up players on the field. But he was so funny. When he'd be mic'd up on USA Network, it was one explicative after another. You've never seen a guy talk more trash than my brother Pete. And he is the nicest guy, but he will talk trash all day long. And the guy's hand will literally be shaking out there in front of him while he's doing it. As far as me, I didn't have nearly the same kind of career Pete had. I played 4 games in Chicago for the Bears. And then this unknown linebacker named Singletary, the Bears picked him over me. And so I was out. My mom said that kept me out of the Hall of Fame, by the way. And I agree with her all the time. But unfortunately, I know it's not true. And one of the things that I'm really good at is I think I'm a very accurate judge of my own talent. And I think that those of us who are honest with ourselves, and you can do that, that's a gift also, almost as good as discipline for a trader, is knowing what you know and what you don't know. As you guys may have seen, I wear weird rings. They're all skulls. I must have 10 or 15 skull rings. I started off with one, and that's why I'm here, by the way, because my brother Paul died of ALS. So you guys supporting this means a lot to me, and I'm grateful that you guys are doing that, but that's also why I have all these skulls. I have skull scarves. People send me skull stuff all the time. So now it's a thing, but it never used to be for me, but now it is. So let me see. When I came to the Bears and played for Chicago, right after that, then my agent said, John, what do you want to do now that you're cut? Do you want to go up and play in Canada? And I said, hell no. No offense, Canadians. But I mean, practice for the NFL is actually really easy, much easier than college, because they never let you hit. But in the games, you hit, and it is so hard because everybody's jacked up. And I don't mean on drugs. In some cases, that's true. But I mean because there's 80,000 screaming idiots, just like in college. But the players are so much faster and so much bigger, position by position. And so the impact is just terrible. That's why I was asking some of you guys, where's that cannabis place here so I can go pick up some CBDs, some cannabinoids, so I can try to keep, my shoulder from aching as bad as it does some days. But it's brutal, football. It's also a blessing to be able to play it. And I was lucky. I never had a concussion that I can remember. But I think it's a fun game, and I love watching it. When it was my turn to, after I clerked on the floor for a while, I think I made $19,000 playing for the Bears. I took all of that after I worked as a clerk for a while and bought a very small seat. It was called a Midwest Stock Exchange seat, Midwest Option Exchange seat. Bought one of those, and I was going to go over and trade. But one of the avenues you could take was to go through the Board of Trade, because they also had seats that you could convert and would let you trade over on the CBOE, because the Board of Trade started the CBOE, in 72 or 73, I forget. I wasn't there. I started in 1981 down on the trading floor. So when it was my turn to go over for the membership committee, you give them a couple grand, you take a test, and then you have to go before the committee. And they go over everything on your resume, as far as where have you been for the last 10 years. If you left anything out, they won't let you on. Who signed for you, because they have a book that goes back to Abraham Lincoln's time. Every trader at the Board of Trade since Lincoln's time has two names next to his or hers. And you have to have, two people that nominate you for membership. So the people that nominated me said, John, when you show up with a suit, show up with a tie snugged all the way up to the top. Don't wear your tennis shoes. Don't wear your trading jacket. They told me all the things not to do, because they said if you show up like that, like most runners from the Board of Trade or the CBOE would show up with, they'll just yell at you the whole time. If you don't respect our rules, how do we know you're going to do what you're supposed to do when you're down there in the pits? And all this kind of stuff. So I listened to them. I showed up at the membership committee. It looked something like that. That's the New York Stock Exchange boardroom. But I didn't have a good picture of the Board of Trade boardroom. But you sit down at the far end of the table. There's like 8 people sitting at the other end of the table. You can't hardly see them. And they start asking you questions about the CV that you've sent them and so forth. And if they find something wrong, then they'll just drill you for 15 minutes and tell you to get the hell out and reapply in 3 months when you can get your mind straight or something. So it's pretty funny. But so I was hearing somebody in the room getting just yelled at, because I saw he walked in tennis shoes. He had an Izod shirt with a tie kind of slung down, around his nipples or something like that, like a lot of Board of Trade or CBOE guys would do back in those days. And so he was just getting ripped. So finally, it's my turn. So I walk in, sit down at the far end of the table. I'm looking at him. And the chairman looks at the papers and he goes, so, John, it says here you played for the Chicago Bears. Is that true? I said, yes, sir. He said, okay. got one more question for you. Did you ever tackle Walter Payton? And I said, yes, sir. And he said, congratulations, you're a member of the Board of Trade. So that might have been the fastest approval process in history for that, because like I say, usually they'll just find a bunch of questions to ask you. For me, just knowing Walter Payton and being with the Bears put me in like that. So I'm grateful for that, and for the career that I started down there, like I say, in 1981, traded actively on the floor, basically until 2001. We sold our firm in 2004, I believe, to Citadel, Ken Griffith, and one of the biggest hedge funds in the world, one of the biggest high-frequency traders in the world. Ken interviewed me 4 times about buying our firm, never bought us, never even gave me a bid, just interviewed us like 4 times. And then I was walking home one day, and we were going to sell to Geneva Partners the next day. And on the way home, I got a call, and it was from one of Ken's right-hand people. And he said, John, Ken wants to buy your firm. And I said, I've heard that before. And he said, no, seriously, he really wants to buy your firm. We need it, because we're going to plug it in. We're going to do all the option stuff that we do on the ICE. We're going to do it on the board of CBOE and Amex and everywhere else. And we need a firm like yours, because we had exposure on all the exchanges. I had 55 traders back then. And it was all my money and Pete's money backing it. Well, yeah, that's not quite true. We traded for Goldman Sachs partners. And so they gave us a bunch of money to trade for them as well. So I have to acknowledge that. But so when it's time to sell it, then since we already thought we had sold it several times with Ken and never agreed on a price, the right-hand person put me on the phone with Ken. He said, hello, John, this is Ken. I'm somewhere over the Alps in my jet. And I said, I'm sure you are, Ken. And he said, don't sell your firm tomorrow. And I said, why? And he said, because I'll buy it. And I said, I didn't tell you how much. And he said, I didn't ask. So that's, I said, so I have your word? He says, you have my word. He says, whatever they're paying, I'll double it. So I won't be so garish as to tell you guys, or gauche, as to tell you guys how much it was, but it was more than a pack of cigarettes. And Ken paid 2 packs for that. But anyway, open outcry trading, that's the way trading used to be. As you guys know, it's virtually unavailable in this form anymore. The only places really where I can see this to some degree are the S&P 500 options pit and various agricultural options. Everything else, if it can trade just bid and offer, and it doesn't have all the different strikes and all the rest, of course a computer could do the strikes very easily. But these are the lone places where there are open outcry still. Agricultural options at the Board of Trade, or now CME Group, or really the VIX pit, but everybody's sitting around like this, like you guys are, with computers in front of them, and it's not jumping up and down or anything else. Back in the old days, it was great, because you'd go down on the floor and it would be, I am sold, as fast as you could, back and forth, just trading in and out all day. But that went away for the most part with high frequency trading and so forth. Doesn't mean that we can't make money trading. Obviously, most of you guys are doing very well trading, and hopefully all of you after hearing all the great ideas you've got here, but I think open outcry is pretty much done in the United States. I just wanted to show you these couple slides before I get into some of the rest of the presentation, because everybody, including the judge, Scott Wapner, on the halftime show, is always saying, why is volatility so small? What does this mean? What does this tell us? It doesn't tell you shit. This is, instead of the most hated rally, the most loved rally in history. The only people amongst us that hate the rally are either straight out short, or they're pissed that they didn't commit more money a year ago, either on Brexit or on the election, because obviously it's just been, from, as Gartman would say, lower left to the upper right. It's moving up. And so why do people hate it? They don't hate it. It's overly loved, perhaps, but it's not a hated rally, again, except if you're a bear. However, when you look at this, global inflows, $12,000 a second into ETFs, this is why volatility is depressed, in my mind. The fact that you've got mass market stuff like this, active to passive, Lower part of that graph, everything diving down, that's the actively managed mutual funds and so forth. Take a look at the others, it's just screaming higher. Again, lower left to upper right. Look at this one, percentage of, as a percentage of US trade, look at the dollar value. I mean, in 2000, when we had the last, well, 2008, we had a big crash too. But in 2000, when the tech stocks were cratering and everything else, it was less than 2%, ETFs were. Now they're over 30% and climbing. So, I mean, when you've got that many people just pushing down like this, that's what's compressing vol. Even when we do have an event like Brexit or like the election, stuff moves for hours and then it just gets crushed right back in because of the ETFs, in my mind again. Growth of the ETFs in the United States, again, you look at it in 2003 was as far back as I could get this graph, but there were 120 or thereabouts ETFs. Now there are, if I read that right, 1,700 ETFs. Obviously not all of them are active as far as big volume traders, but the fact that there are that many out there and they're, whether it's a 10 stock ETF, a 30 stock ETF, or a 500 stock ETF like the SPY or 2000 like the IWM or whatever, that's just crushing, vol and squeezing it like this. Does it mean it'll stay low forever? I'm not saying that. But when it blows through and all of a sudden the ETF isn't working or they're not getting enough liquidity for whatever reason, that's going to be an interesting trade and it will be a big move the days that happens. But until then, everybody will just be TFD. You guys know what that is, right? Buy the effing dip. This is so far the first month in history where we've averaged under 10 for volatility. Last boring volatility slide, but nonetheless, take a look at that. It's just been trending down, folks, the VIX, from being, we did this on TV, I think, last week. Volatility and moves in, I picked 2002 rather than 2000. It would have been stupid because volatility exploded so much in 2000. But 2 years later, we were still seeing like a 25-point move in vol. For instance, from like, let's say a low of 16 or something like that to like 40 something. We'd see that in 02. And then it compressed from that 25-point kind of move in a year, that was a yearly movement, to now this year, I think it's right around 8. I don't mean the real vol, I mean how much from high to low this year that we've seen in volatility. But creates opportunities. Quick couple examples. I know you guys are way beyond covered calls, but for those of you who aren't, just wanted to show you an example of what people do wrong when they do this. So this is IBM covered call. There's an IBM chart and so forth from this year. And obviously, Buffett starting to bail. You see that big red line there? That's on the chart on the right-hand side of that. That's more or less Buffett deciding that he can't take any more pain in that thing. And I'm sure he wished he sold the whole position. Take a look at that current IV. It's the lower right-hand side, current implied volatility, under 10. A lot of people look at covered writing the wrong way. They look at covered writing and they say, well, I want to get, I want to sell the 30 volatility stuff and the 40 volatility stuff. For the most part, no, you don't. Selling the higher volatility stuff is the stuff that's going to move. The highest volatility that any of us know of really is usually biotech, because cure for cancer or nothing. It's a binary bet. So to see 200% and 300% vol on some of these things, now that doesn't mean you can't trade them or you can't sell straddles or strangles or whatever you might want to do, condors. You can do all that stuff. But if you were somebody who just wanted to manage, your inheritance and be in the right kinds of stocks and covered write them, which is what we call, collecting rent. I want to be in that kind of stock, a stock that's moving at a 10 implied volatility, not the next example that I'll show you after this one. So for instance, IBM, you own the shares, you sell calls against it, no additional margin. That's not bad. You make about 1.5% every 40 days or every 47 days. So if you did that 8 times a year, you can boost your return take it to about 11%, and you got a 4% dividend. Life isn't so bad in a zero interest rate world. Now you take a look at that and compare it to this one, Sarepta, one of those, high-flying kind of binary bets from time to time. Current volatility, 62. 62 tells you that thing's going to be all over the place. Volatility, by the way, folks, so you take the square root of the number of trading days in a year, 256. The square root of that is 16. That's why whenever we say a 16 VIX means you're pricing in a 1% move on a, let's say, a daily basis. So if you're seeing 32, 2% move, 64, 4% move. So that thing's saying Sarepta should move about 4% a day based on math and how much, when you feed in, the Black-Scholes and so forth, or doesn't matter if it's Cox-Ross or if it's binomial, whatever option pricing formula you're using, the higher the vol, you're looking for movement there. So as you saw in IBM, it's barely moving 0.5% a day based on its volatility. So those are the kinds of stocks that it makes sense to be a covered writer. Again, hands out, you're selling. Hands towards you like this, you're buying. So if I'm hands out and I'm selling, I want to be selling in a 10 volatility stock or a 14 volatility stock, not necessarily a 62 volatility stock. And that's the current, the range. Take a look, it was 223 just before they had this last report where they had better than expected adopters of a certain type of treatment that they have. So that's Sarepta, and this is a portfolio. Now this is a person who was a big Wall Street guy. By big, I mean he ran one of the biggest houses on Wall Street. I could tell you guys, but then you'd be able to figure out who it is, so I don't want to do that. He's a client, because we do wealth management. We have a multifamily office, and we manage money for institutions and things as well. So this gentleman was introduced to me by Stephen Weiss, somebody who's on the halftime report with us. And Stephen's a great guy, but we're some of the few guys who like him, my brother Pete and I. A lot of other guys are really annoyed by him because he can be really difficult to deal with. But he was nice enough to introduce me to this guy. The guy sent me his stocks and said, John, what can you do for me? Here's my stocks. I don't understand derivatives. This is a guy that's done swaps on, Brazilian debt and all that kind of stuff. And he says, but I don't really do derivatives like you guys do. I don't want to watch it all day. I just don't want a share ever called away from me. So what we did was we showed him this, and we said, well, what we would do is he had about $6.7 million in just stocks. Facebook, Apple. I mean, he had the who's who, a great portfolio of stocks. And he said, what can you do for me? And I said, well, presently you have a $6.7 million mansion that you're not renting out. I said, I'll rent it out every month for you. He said, what'll I make? And I said, well, so we did that. That's the actual math there, about $135,000 a month. So he became a client the next week. But 135, is that free money? No. But again, I was discussing with Greg not too long ago that if you have an apartment, again, 6.7 million, or if you want to break it down and say it's a 1.7, I've got, three $1.7 million apartments, and I'm not renting them out. I just I'm holding them for upside appreciation or whatever you would do. This makes a hell of a lot more sense because you've got a lot of money tied up in stocks, and you can make money from somebody else that wants to speculate that it could go up more than 3 or 5%. That's usually where I sell. 3 to 5% out of the money, usually out there 30 to 45 days. Unlike a lot of my peers, when they do this, though, we don't buy high, sell low. You buy high, sell low when you're doing covered rights if you do these covered rights and only buy them back when they go in the money. Why is that? Because now I'm buying back 100 delta, an in the money call becomes 100 delta, and I'm selling a 50 delta out 45 days. That's buying high and selling low. That's stupid. So our algorithm automatically trades this, and if it's somebody like this guy who wants to do things like, since he doesn't want it ever called away, we can do a flex option. A flex option, folks, is where you can call every term of that option. Expiration date, do you want American, which means you can exercise it before expiration, Or do you want European, which means you can't? It goes all the way till expiration, so it's never gonna be called out. And then we just roll those and so forth. So anyway, I show you that because a lot of folks focus, I think, on the wrong things when they're thinking about, should I be a covered writer or not? The answer is, it's a great way to trade and a great way to manage your wealth going forward, but you don't want to do it on a bunch of freaking biotech stocks. Whoops, there's the Sarepta, sorry, I lost the slide in there. It shows you how much more tempting. Okay, so instead of 11% for IBM, you'd make 39% on the exact same strategy in Sarepta. But there's a reason, especially in a 0 interest rate environment or a 3% interest rate environment on the 30-year, where you probably should be suspicious when you see a 39% potential return that maybe there's a good chance you could go broke on that stock too. This is our heat seeker. So when we started, Pete and I, managing bigger and bigger money, right about that time, the SEC threatened all the exchanges and said, you know what? We are very suspicious that you guys are colluding to not compete. They weren't focused on me. They were focused on all the exchanges. There were back then, let's see, the Pacific, the CBOE, the Philly, the Amex, and the ICE, the International Securities Exchange. The New York brought back their options exchange just after this. But they said, focusing on you guys, why does Dell only trade in Philly? Why does Microsoft only trade on the Pacific? Why does IBM only trade in Chicago? We don't think that's right. You guys should be competing. This should be listed everywhere. So once they put the gun to our head and basically threatened us with collusive activity, the exchanges collapsed and said, okay, we're listing everything. So they did. And all of a sudden, guys like me who used to stand in the pit next to the IBM broker that had Schwab, E-Trade, Goldman Sachs back in the day, Bear Stearns, Lehman Brothers, all these different brokers are standing right next to me. I have to be an idiot not to be able to make money once I figure out that when that guy's buying, I'm running with him. I'll sell to him, but I'm buying everything else in the pit. I'm selling every put, I'm buying every call I can get. And we're all competing, so it's all just on speed. So as soon as you start to see the stock tick up, buy them at a half, sell them at 3/4, you know, just bang, 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 like this, as fast as you could go. But when they took that away from us, and all of a sudden only 20% of it's trading in Chicago, and the other 80% is spread over those other exchanges, the value of the seats went from 700,000 down to 200,000, like that, because nobody was making money anymore, not like they used to. Again, there were guys that would just trade for the first hour and be done. Go down to the bar and sit there and bet on pitches, balls, and strikes. My hand to God, they would go down there with stacks of hundreds and just bet on pitches. Ball, strike. Watch the pitch, drink, ball, strike. It's the craziest thing, but it was like free money. So anyway, we needed to recreate that edge. So what we did was, Pete and I, we created an algorithm that we call Heat Seeker. Again, I know there are smart traders in the room. I've already named Wall Street Jesus, Open Outcrier, and a number of you guys that actively trade this stuff. So again, I'm not saying I'm the only guy with this, but we created an algorithm so that human beings aren't doing this. So what our algorithm does is, as you can see there, I'm looking at, I could run, if I take a look at that top bar, I could look at the sector viewer, the exchange summary, largest trades, momentum, most active, all the way down to, on the far end that I didn't put on here, unusual activity. And so we're seeing whether it's block trades, and I'm looking for blocks on the offer. That's all I care about, blocks on the offer. And we all know some traders are smart enough to break up their trades. So it's going to be a 5,000 option print. They know it's going to catch your eyes. So what do? Break it up, spray the exchanges with it, and so forth. Ours just takes a look, says these all traded in the same second. And so we just put it together, trade it on the offer. We just run like along with them. So we're effectively like surfers. We're just out there in the water, you know, just waiting on our board, and all of a sudden we can feel the waves starting to pick up and we just paddle like crazy. So that's what we do. In the simplest terms, we are following those guys. And that's why some people, when they're critical of me on Twitter, or Pete, they'll say, these clowns, all they do is follow the fast money. And I'm like, yeah, that's all we do. It's true. But then we try to cut our risk as much as possible too. I'll show you little examples of that. But basically by things like doing a spread. A lot of you will say that a majority of options finish worthless. True, but there are a shitload of strikes. So of course a lot of options finish worthless. But at some point during that option's life, did it pop? Did it give you a little lift? And the question is whether you were fast enough to take advantage of that, or if you decided instead of just open-ended time decay and volatility compression sitting there ready to club me over the head, maybe I'm buying that call, and as the stock rallies, I sell calls at a higher strike above it. So now I've basically lucked into a spread that, 1-to-1, I've got no upside risk or whatever, and I've cut my downside to almost nothing. Because if I catch that wave, and I'm buying these calls at $1.50, and then by the time I get to sell the higher strike, the stock has started to lift, and I'm able to sell the higher strike for, instead of 60 cents, maybe I'm able to sell them for 90 cents, a buck, or whatever, taking my risk way down in that trade. Now time decay doesn't matter to me, because I've got one option against every option I've bought. I've got an option short side against it. Now time decay is not my enemy anymore. Volatility compression, same thing. Vol drops 20 points, play with that on your computer and see what you think. Vol drops 20 points, it's gonna hurt both. The one you bought and the one you sold. So, you can mitigate that. And that's one of the reasons I love doing what I do, because I can participate with the biggest players on the street and have a lot less risk. So again, for those of you who don't trade a lot of derivatives, this is why, like I say, with the heat seeker and so forth, why we think it's so valuable. Those three things: time frame, strike price, leverage. So if I look at that time frame, when I'm looking at that, I'm saying, okay, what expiration were they buying? Were they buying this week's expiration? I'll show you an example of that. Wednesday, they're buying Netflix. I think the stock was 179. They're buying the shit out of the upside calls. Weekly calls that expire in 2 days. They expired yesterday. So they were buying those calls on Wednesday, paying $1.70 up to, I think, a high of maybe $4. And they settled back and forth, so you could have bought them. Did you do those, Jim? Yes, sir. Oh, damn it. Those trades, folks, by the way, Netflix, as you know, increased their cost of subscription by $1, and the stock ran from 179 to 199. The right to buy it at 185 basically went to 13, 14 bucks. So to turn $2 to 14 bucks in 2 days, and I didn't buy the low, didn't sell the high, that's not the story here. The story is, if they're buying short-dated stuff where they think they have minutes to be right, that's what I love to follow more than anything. If they're buying short-dated stuff, now it's also the most risk, which might mean that you need to put on a call spread there, which I did, unfortunately, which is why I turned a $1 spread into a $5 spread. Love it, 4 times my money, but I didn't turn $2 into 13. I didn't do that. I just picked out a spread, bought the 180s, sold the 185s, or maybe it was 185s, 190s. Stock went through 190. I don't participate anymore, but I'm just saying, take it. Take the stock, please. Or I buy a put to lock it in, depending. I didn't have to because it was just off to the races in that example. But again, time frame. It's important because if they're buying, in that example you see on the screen, if they're buying something that's 30 days, 60 days out there, that's more like an investment. That doesn't mean I don't follow it. I'm just saying I treat it differently than I treat the very short-dated stuff where somebody thinks they've got time-critical information. Quick story, biggest loss on a day, 7 figures. Not trading, not doing like this, but we owned 80 different books on the Pecos, Chicago, Amex, and the Philly. One of those books was SciMed Life Systems, I think it was Smiles, SMLS. The reason I know this so well, because that was my birthday. On my birthday, with 20 minutes to go before the close, a firm with a name that rhymes with Goldman Nachs, came in with 20 minutes before the close and started buying a shitload of puts, out of the money puts. Let's say the stock was 90. They're buying the 70 puts. And so we're like, and I wasn't there. But I'm upstairs monitoring our guys, and all of a sudden I'm seeing all these trades coming in, and they're starting to sell them at $2. They expire in like a month, but it was still way out of the money. The stock's 90, they're buying the 70 puts, and you guys have sold them up for $2, and the guys are saying, I can't believe it, these guys are stupid. And I'm like, they are? I don't know. Who's buying them? They didn't get back to me till the close about who was buying them, or I would have told them. But they bought them, they bought thousands, all the way up to about $4. Well, SciMed comes out with earnings right after the bell. Earnings are fine, but the guidance sucks. They take the stock down to 50 or something like that in the after hours and in the trading the next day. So like I say, so it's my birthday, and I'm down 7 figures and could be worse. So not a happy time. But we did climb back from it. We actually, over the next 2 months, probably made all that back and then some, because it was really a great stock trader for a while. But the bottom line is, if they're coming in late and they think they know something, how many of you guys watch Billions? None of you? A couple of you, okay. So Damian Lewis plays basically Stevie Cohen in Billions. And he's explaining to his lawyer how he finally got it as far as how trading really works. And he said he was going to the track, sort of like the guys at Susquehanna, if you guys know those guys, brilliant guys. And they're all horse bettors. They'll bet on any horse race. And they think they have a significant edge because they're really math geniuses. And so Damian Lewis, more or less, is playing off that. And he says, so he said, I was a big contributor. I'd lose a lot. And then I noticed the guys who came in late and bet big, they won. So he said, I started following those guys. And that's when I started winning. That's what I turned into my strategy on Wall Street. And more or less, that's my strategy too. If you come in late and you think you know something, I'm going to run with you. So especially into earnings, when I see late paper, meaning the people that are in there buying late in the day, I'm probably setting myself up in a big long position. Or if they're coming in and they're buying out of the money puts, I'm buying the shit out of those same puts and trying to do a spread or something because they're right. The big money comes in late, it's right. So anyway, time frame's important. Strike price, because they're telling you what level. If somebody's buying a whole bunch of at the monies, that's one thing. If they're buying a whole bunch of out of the monies, sometimes it's just for the leverage, that's the next slide, but other times it's because they think the stock could see that 10 or 15% pop. As Carol said, when the SEC asks me for my data, and they asked me for my data on Equifax, Maxine Waters, if any of you are fans, her assistant sends me something on their official letterhead from the House and says, we want your data on Equifax. Do you mind sharing it? No, I don't mind sharing it. Because they were buying a shitload of puts in Equifax, and it trades by appointment. It doesn't trade at all. I mean, it trades I think it traded 200 or 300 puts a month for the last 6 months, maybe. And somebody bought 2,500 the week before they announced that they have this issue that they didn't bother to tell any of the rest of us about for 30 days. But anyway, so strike price, when they're buying the out of the monies, calls or puts, that tells me something. Again, there's a lot of information in the options that those of you who aren't already trading options should at least pay attention to, if not trade them, because they're telling you things. And it's not like a crystal ball, but it's pretty damn accurate. Leverage. Why would they trade that $2 option instead of the stock? We both know the answer. We all know the answer. I get tremendous leverage from this stuff. And every once in a while, you see something huge like 2 weeks ago or so, somebody stepped in, bought 141,000 Spider calls, just out of the money. Spider was, I think, 248 or something like that, if memory serves, and they ran it to 253. Not overnight, but I mean, holy shit. They turned a 20-cent option into $4. I mean, who doesn't want that? And who the hell else is buying 141,000 calls? a hedge fund that's already long and levering up. You know, again, most hated rally ever. They might not want to buy, you know, whatever. That's 141,000, by the way, guys. So every 10,000 is a million shares. So they're buying a shitload of Spider when they're buying that thing, 141,000. So they're buying 14 million share equivalent in the Spider. I want to be on the same side of the trade as those guys. And I can understand why they're not maybe putting all that money into the futures. So anyway, even though you get a lot of leverage with futures. So that's leverage. Volatility, you guys know this, bell-shaped curve. Guys in the middle, those are the C students. The guys on either side, you're either a D or a B, and then you've got the A's, and the rest of it is like black swan territory. All of the math in options is why it's not a black art. I mean, I'm not saying it's 100% predictive, but I'm saying there is math behind all of this stuff. So when you're saying one standard deviation, so 68% of the time, that stock should trade between here and here. And you can just back into the vol and figure that out. Two standard deviations, what is that? That's another 95% of occurrences should occur between those two, between the 70 and the 130 on the bottom of that screen there. That's valuable info. And then, of course, the black swan, which I've lived through at least 4 black swans in the broad market in my 36 years. It's only supposed to happen once in a lifetime. There's a black swan event almost every week. It's just individual stocks and so forth, but there is a black swan event all the time. How much will Apple move? Last thing, as far as what you guys should pay attention to with the options. If you've got a straddle, because that's what that graph is, anytime you see that, you know it's a straddle, whether it's simulated or otherwise. That's a straddle. If the combination of the call and the put at the same strike, you just take that and divide it by the strike price, looks like this. So if that straddle in Apple at 162.50 is trading for 550, you divide the 550 by 162 and you get 3.5% roughly. So that's telling you that up and down, instead of just saying, well, you know, you could 157 to 167, you know, $5 on the 162. That's how much it's going to move. Percentage-wise, that's how much it's going to move. And you can set yourself up with great trades based on that because you take advantage of, for instance, the fact that the Apple, for instance, is probably trading at 50, 60 vol on the weeklies, and the next week out, it's probably 30. So you can do all kinds of exotic stuff to set yourself up to make money pretty consistently on those kinds of trades, whether you're trading condors, butterflies, whatever you wanted to do. This is a little bit more about our heat seeker. So as I told you, so Pete and I created this algorithm. We plugged in, so we don't buy data from the regular data sources. We have 4 1 gigabit circuits to the internet and 1 10 gigabit circuit to where we're pulling the data as much as live as possible. And I could tell you that during the flash crash, the quotes were at least 15 or 20 seconds behind. You can see it when you can see it. Some of you have told me that you watch CNBC through the internet instead of coming over cable where it's, you know, bounced off of a satellite and back down. There's a delay. So if you really needed something time critical and you're watching it without that, that's very valuable. That's what we're seeing. Except, of course, it's not my eyes. It's the computer. And the computer is parsing them and dropping them down saying, here's the ones you need to watch, John. Here, 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 here. And so when we say there's fast paper, it's flowing into this stock right now at this level, that's why, because the heat seeker's doing it, not me. That one is the data center in Mahwah, New Jersey. You can see all the servers that are there to make sure that none of us can make money, but most of us make money anyway. You just can't compete at their time frame. I mean, for a while I was a high frequency hater. Now I just use the liquidity because you can't beat them at their game. And they've pretty much mined it dry. I mean, there is almost nothing left for the high frequency guys, so maybe it'll widen out a little bit, I don't know, not predicting. I'm just saying, when you've got miles of fiber optic cable down there, and every one of them's 1,000-foot spooled so that they all have the exact same connectivity to the central processor. They wear each other out. They've taken, if you've read about Virtu or any Ken Griffith or DRW. DRW, anybody know who that is? Don Wilson. He's probably the first billionaire from the pits and made it trading euro-dollar back months. Parlayed that into starting a firm called DRW, Don Wilson. Brilliant guy. Don has thousands of traders, and at one point, he nearly took down the electric grid in Chicago. They were drawing so much power to the building that they finally had to tell him, you can't do it. Can't do it anymore. So we were able to, we were able to rent his offices in that building, and he left everything. They just basically had to move the whole place to where they could draw it from 2 different points instead of just one grid, because on a busy day, they could practically take down the grid. They had so much coming through there. Again, one of the biggest high-frequency traders on earth. This is why you need direct connection to the exchanges and so forth, and to be able to pull at a 10 gigabit circuit, which means the manhole I'm going through is like this, and the fastest any of you in the room, unless you're running a high frequency, is probably like that. I mean, it's a pin to a pipe that's that big. Costs $100,000 a month, though. How many want to sign up? I mean, not our data. I mean, a 10 gigabit circuit, always up, because you can't be down. Anyway, in 2007, there were 240,000 quotes per second coming from the floors or from wherever, from the ether. Now there are 9.5 million a second. 9.5 million. So I like to say that this is like I pick up a hand of sand and I throw it in your face. You can't see. There's so much data now that it's almost impossible to sort through unless you've built the machine to do it, because there's just too much data. So it's the greatest thing in the world for covering their tracks of traders that don't want you to see what they're doing. And I don't blame them. They pay a lot of money for the information that they get. As I was telling Chris Irons yesterday, that's what Gordon Gekko said, the most, the most valuable thing in the world is information. You get the information faster than somebody. This is a trade. These are Apple trades in 2007. So as you can see, there's probably they're all in the same second, and the stock is trading from a low of, I think, 162.08 to a high of like 162.10 here. I think I had to cut off the slider. I was afraid the fonts would be too small, but I think it was between 08 and 14 cents. So in other words, it was trading basically in about a 6-cent range in the same second back in 2007. Today, those are spider trades. So that's the SPY, the SPY trades, not quotes. Those are trades, as you can see, down this column here, over here on the side, this is all size. So that's 1,000 shares, 200 shares, 177, and so forth. So those are actual trades. The spider probably quotes close to 230 or more a second, and it probably trades close to 100 a second. So again, how do you see the one that's important when it's going by that fast? And the answer is, I don't care what kind of virtual reality headset you put on, you're not seeing it, but the computers see it. This I show you because a friend of mine who's an active guy on Twitter too, he tracks volume in a very unique way also. This was Qualcomm. So that white line, those dots, those are all trades. And this is Qualcomm trading in a single second. And in that same single second, Qualcomm, this was in, I think, 09. Qualcomm traded from roughly 50.75 all the way down to 49.20 in the same second. There were mini flash crashes every single day, all the way up until they basically put in circuit breakers to stop it. Because a stock, the high frequency guys would see something happening, or somebody that was, as you may have heard, they used to let you peek at what was in the dark pool. If you guaranteed that you'd interact with a certain percentage, you could peek and see what's going into the dark pool. So you could see that there's a whole bunch, the guys would ping the dark pool, and as soon as they hit something, an iceberg order or whatever, then they just slam after it, and that's what that is. You can see somebody was trying to sell at 50.75, and they took it all the way down $2 and then back up in the same second. So those fills down there at the bottom, that flat line in the middle, where it more or less flatlines, that's where they're all buying back. So some machine is making a fortune. I forget, I think this was like 178,000 shares or something like that. So how'd you like to make 2 points on 178,000 shares? Not that one person did that, but the high frequency guys all saw it at the same time, rammed it down. As soon as they stopped hearing offers, then they bought it all back and it ran right back up. I mean, just amazing, same second. Since we've got Mr. Leff speaking this afternoon, Andrew Leff, who I've enjoyed very much on Halftime Report. Here's what we saw on Shop a couple weeks before Andrew came out with his call. Somebody came in and bought a bunch of puts. What a surprise. Again, Andrew's a smart guy. This is not accusatory, please. I'm not doing that. I'm saying that it could be, somebody that just got lucky and bought a bunch of puts right before that. But coincidences are rare on Wall Street. It could be Andrew himself. Again, nothing wrong with that. He's done this great work. If you guys don't think that it's a believable story and instead you fade it, okay. Doesn't mean that he's going to drive it down. Every time I mention a stock, it doesn't always jump. Sometimes it does if I make a good case, or if it's a stock that's breakable or a stock that can go up. But all of mine are done with full disclosure too. And I know whenever Andrew's been on with us, he always says, yeah, I'm in this one, I'm short for the long term or whatever. So again, this is not me accusing, this is just me saying 2 weeks before he made his call, those puts were bought. 110 puts with the stock at 122. That's Shopify from the day he made his call with the stock right around 118, I think, or so. And it traded down to, what is the low there, 98 now or something like that? Hell of a call. Here's Netflix, the one I told you about. So early on in the day, this is Chicago Times, by the way. So in other words, in the first 2 hours of trading, somebody starts buying a bunch of 130 of October 185 calls for $1.70 up to 440. They also came in and they were doing 190 calls and so forth. You know about the move in the stock afterwards. There it is. It went to a high of 1376, I think, yesterday. Not a bad return for 2 days. Here's Wynn. Somebody said, I hope Steve Wynn's really treating you well out there, John, because you guys own so much of his stock and you trade it so much. He has, and I guess he was over, Andrew saw him yesterday over with Karl Rove, right? Over at the Encore. So anyway, Steve, great guy. He's probably the Elon Musk of gaming. This is a great facility. I've certainly enjoyed this one. There is Wynn trading on September 21st. They come scrambling in, buy the weekly calls for 250. It had no open interest. There's Pete talking about it. Stock's 144. He's talking about the call strike that they're talking about. There it is on my birthday last week, for those of you who want to remember and send me something. There's Wynn trading up. I think it might have traded to 6 that day, but there it is with, I think the bid at that time, 485. So again, here's AbbVie, a reason that we love trading those stocks on that unusual activity. Stock only made that $4 move, but the options tripled. So 300% for the options versus, I don't know, 5% move in the stock. That's why I trade options. You guys all get a book. Remember, if you fill that out, you'll all get a book. I know a lot of you are active option traders already. I think you should be, because you can cut your risk, be in a great trade. You can weather the ups and downs of it. Those of you who have been using stock stop losses, when you start using either a call against your shorts or a put against your longs, I bet you find you make more money and you don't get blown out because if something gaps down, your stock gets slammed at the bottom. almost guarantee it, or the top, depending which one it is. Whoops, let me see. This one was Equifax. As you can see, trades by appointment. There's no open interest in anything. And all of a sudden, that thing kind of sticks out like a sore thumb. The 135 puts, the only strike with any volume to speak of. And by the way, the insiders, I think you guys saw this too. 2 days after it was found, July 29th, they found out, the internal document shows, July 29th, they knew they had a hack, and they knew it was substantial. 2 days later, 3 insiders sold big, $13 million worth of stock. I guarantee a couple of those guys are going off in cuffs because they're insiders. Insider trading is material, non-public information. And there's no better example than somebody who has material, non-public information than Equifax. And then somebody, again, a week before Equifax comes out with the, this is right before Labor Day, somebody buys a shitload of puts, and then after Labor Day, they make the announcement and the stock goes from 142 to 90. And then, by the way, and I believe I tweeted this out, when it finally stopped at about 90, that was the absolute picture of capitulation. I mean, everybody came in, threw everything out. Elizabeth Warren's on Capitol Hill talking about it. I mean, and the stock traded like, I don't know, 10 times normal volume. If that's not an exact poster child for capitulation, nothing is. And now the stock, I think even though they were getting slammed on Capitol Hill again this week, I think the stock, I can't remember if it's 110 or whatever, but it's 20 bucks off the low, like that. And again, you could have been in that with options. So now with that said, I'm right at the time that they allowed, but if you guys want to ask a couple questions, Zach said we could do that. So if you have a question that I can answer, I'd love to try to answer it. Anybody have one? Sir, just one sec. He's going to bring you a mic that way, since the camera will hear it too then. Thank you.
Test, there you go.
Thank you. Would you be looking at out-of-the-money options? This activity happens most at out-of-the-money options or sometimes at the-money options as well? So
as you guys heard, out of the money, does that mean more to me? It does. But it doesn't mean that I don't trade the at-the-monies. When I see at-the-money stuff, and because, especially for clients, we're more likely to trade an at-the-money and turn it into a call spread or a vertical spread. Buying the 50, if I see the 60s or 65s being bought, we might buy the 55s and sell the 60s against it because number one, they're buying the 60s so they're pumped up higher in vol and they're moving faster. So maybe I can buy the at the money and sell those 60s. So I like that, and it's a more conservative trade. But the 60s, you know, that's the levered bet that's going to go from 20 cents to $4 when they're right. So that's why I love that bet. And by the way, just real quick if I could, because it kind of feeds into another part. My rules when I'm trading, and you guys all have yours, my rules are that if I buy an option, these are all option issues. If I buy an option and it loses 50% of its value, I sell it no matter what. On one exception, if it's under 50 cents. If I buy it for 50 cents and it goes to 25, I may or may not sell it. I might just hang with it. But if I'm buying an option for $1 and it hits 50 cents, I'm out. Sometimes even before that. In other words, because criticisms I get on Twitter all the times are, you don't talk about your losers. Fuck, did I tell you guys about every D I ever got or anything like that? You know, knock on wood, none. But I'm not going to tell you about dumbass stuff I did. But in full disclosure, I'm going to try to talk about the good stuff because I know it draws people in. I'm willing to admit to the bad trades. Half the time, I'll send CNBC, this one didn't work, we should cover it today. And sometimes we actually do. A lot of times they just go, we didn't have time, we didn't run it, John, or whatever. And I say, yeah, I know, I get it. But because they don't, not every single day do they even do our unusual activity. So they don't necessarily, you know, once a quarter they want to hit us on, oh, this was a terrible call. I get it. But I'd like to say that I'm decent at marketing. And if every time, I probably am somewhere, and again, the guy standing with his arms crossed and back by the camera is Andrew. So he's in our office with me in Chicago every day. When I'm trading and we're wrong, probably 20% of the time. But if I'm right, 70 or 80% of the time, it's just a question of when do we take the profits. And I'm greedy, so I always take them too fast. Some of you guys have much bigger balls than I do. Like I said, my brother Pete does. So I'm almost never owning an option at $1.50 that goes to 10. I've sold it at 6, and I'm thinking I'm a genius, and then it just keeps running or whatever. And that's okay, that's a happy problem, right? But I think with the options, you can definitely limit your risk. So I cut them if I'm wrong, and if they double, I take off half. And as soon as it starts to pull back from there, I'll take off the rest. But that way, options at 2 goes to 4, I've sold out half. Goes to 6, great. I've taken profits and so forth at that level, or I'm selling another option against it. So I'm always trying to manage the risk on both sides. Risk of holding on to the winners and the risk of cutting the losers. Sir. Here we got like 10 stick mics and you got, that's okay, he's up at 4 in the morning and drinking 10 cups of coffee, he's ready.
So, great presentation. So
Thank
going
you,
back
sir.
to the Smiles example where, one of your guys sold those puts at, 20 minutes before to the guy who came in late and big. So you would think in those circumstances, you wouldn't want to make those sales. So
right.
What sort of instructions or rules do you guys have within your firm to, when someone does come in with a big trade late and some out of the money puts or out of the money calls, to not sell those because they might know something, knowing that the chance that you're going to get steamrolled is pretty high? Or is it just a matter of price? If those guys are coming in late, you'll still make the trades, but you'll
We'll scale into it and things like that.
Yeah.
So thank you, Ryan. It is a great question about, might not have been Ryan, it was, okay, right next to Ryan, sorry. So what we do is, we would always, every morning, we would sit around the table before trading started, usually at 7:30, trading starts at 8:30 in Chicago. So we'd sit around the table at 7:30, and each guy that ran his pod, this guy biotech, this guy railroads or transports, this guy whatever, industrials, each guy with his or her expertise would sit there and we'd go through every single page, not every position, but every stock, the overall position. So we'd go through that, and then I've fired more traders because of this. I would tell them, you can go home long or short, but if you're going home long, it's because you wanted to go home long, because you had a feeling that there was a whole bunch of late day call buying and you wanted to be 20,000 long or whatever. Good reason. If he's following the paper and he decides to be on that, I'm probably not firing him for that. But I am firing him if he tells me, I'm saying, why are we freaking 50,000 long and whatever? And he says, well, they came in and sold me a bunch of calls at 2, and then I bought more at $1.50, and I bought more at 1. Did you hedge them? No. Why? They're hitting your bid into the close. Are you fucking high? Why would you do that? So in other words, if you come in long, make it because you wanted to be long. If you're coming in short, make sure it's because you wanted to be short. I know you guys aren't market makers, most of you, but that's why. Don't let the market tell you where you're going to be. Make sure you do it yourself rather than letting the market. So in that example, what would I have preferred that the person did? Because we were way too long by virtue of out-of-the-money puts. I would have preferred that they were selling them at 2, and as soon as they saw how many they wanted to buy, because basically the Goldman broker just came in, stood there and said, buy them. And it's like, come on, guys. It's Goldman Sachs. If they're saying just buy them, don't sell, 5,000 of them. Give them 200, 300, get a hedge off quick, sell them more at a higher price. How are they now? 2 to a half. Are you kidding me? Yeah, they're 2 to a half. I'll buy them back from you at 2. Do you want to sell them to me? Pay 2.5, 500. Where are they now? 2.5, 3. You want to walk it up. You don't want to sit there in front of a steamroller. So that's what I would have preferred that they did. And get flat by the end of the day. Not flat units, but make sure that you have some sort of protection against this big bet that came in late. Because otherwise it's like, you know, if somebody came in late for McGregor versus Mayweather, if they came in late with a crap load of money on McGregor, I don't want to be the casino that takes the other side of that bet. Because I think they're going to be right.
Okay, one more. Who wants it?
Okay, one more.
Are we good? We good? All right.
Okay, we're good.
Yep.
You guys, thank you very much. Make sure you fill out your form. Get a free book.